Good morning. You've heard three excellent speakers and well practiced in the role. Pardon me, I'm just a simple numbers cruncher. To me, everything comes down to numbers. Thank you for that introduction, and thank you for bringing me and my wife back to Mumbai after 22 years. A lot of good things have happened, and more are likely to happen, if I have this correct. Before I begin, I should do as the jobbers on the floor of the London Stock Exchange do and announce their positions, or what is called pitching their book. In the same light, I will briefly identify my investment positions. I'm a long-term investor in mutual funds and mutual fund management companies. And these are global, my investments are in global financial services. To me, in listening to the three wonderful speakers, the next thing is to focus on your number one problem. Your number one problem is confidence. The Indian people need to graduate from savings to investing. You have a 97% failure to communicate to these households. You need to get them to move from away from cyclical attitudes to secular. India has a very high savings rate, but most of it's going into deposit banks. Now, the interesting thing is many of these banks are major mutual fund management companies. I happen to have great confidence that you will succeed. And as usual, I will share some of the things that you already know. India has a large population, and in time will be larger than China. The current middle class, as defined in India, is equal to the U.S. middle class. In the U.S., over 40%, actually close to 50% of the households own mutual funds. On average, they own 4 funds, and that's excluding whatever is in various retirement plans. Your total net assets as an industry are approximately 15% of the U.S. I am confident that you will have more assets than in the U.S., or 6 times today's level. Now, I will now violate one of the rules of giving estimates, and that is never give both an estimate and a date to reach it. I will now suggest that it will happen within the lifetimes of my youngest son, who is 50, or at worst case, my youngest grandson, who is 11. Overcome your own and clients' cyclical attitudes in favor of secular. The approach that we use is to avoid market timing by setting goals. The way we do that is we try to get people to divide their investment needs into various time spans. We happen to use 4. And the key is to working with them to identify how long are those time spans and what they are meant to do. We focus on the use of the money after they have invested. So in other words, we're interested in bill payments. And then the measure of success is that ability to deliver on those payments, not versus some statistical measure. Your key to this is risk assumptions, risk control, and client management. And by far, the biggest is the last. I'll give you some examples. In our third time span, which is what we call the endowment period, and that is the period of the grantor or the source of the money's lifetime. And we can use 20 years as a rough example. There are many ways you could fund this. You could fund this through fixed income and stay with the banks. The only problem is inflation. There's another thing you can do, which is to use commodities. Commodities are wonderful trading vehicles, but they're dependent on the perception of shortages, not necessarily the reality. Historically, the biggest return for risk is equity. And this is where we think you and most of the fund buyers around the world should be shifting. There is an incredible growth in the use of bond funds in the US, Europe, and here. I want to talk just a brief moment on indices. Indices are based on somebody's idea of what the central market is. And they then prescribe the weights to be put into the indices. Many of them are market capitalization weights, others are equal weights, but they're fixed. Your active managers have the ability to choose. One of the things that we do when we look at funds is to see how much is in their, say, top 10 holdings. That can be as little as under 20%, or in some cases, 70%. If we look at selection with an index, it's automatic. With your managers, it's specific. We also look at the internal movement within a portfolio. Things change. And one of the problems using indexing, at least in the US and I suspect elsewhere, is it's starting to fall apart. Not totally, but partially. And the reason for that is two very simple statistical terms called correlation and dispersion. The correlation is how tight the group is. Dispersion is how broad it is. We're starting to see that it is pulling apart. This is not to say that there isn't a role for passive investing. We, matter of fact, use some passive vehicles. but those are carefully chosen. I'll give you an example. In looking at large cap value, there is a Vanguard fund, which is a index fund. Then there's another one called DFA, large cap value. We're focusing on the Russell 1000, which is the largest 1,000 companies, self-determined. The index that the DFA fund uses is based on book value, profitability, and, interestingly enough, on their daily trading acumen. On a year-to-date basis, the Vanguard fund is up 4.81%, and the DFA up 6.60%. For 10 years, the Vanguard fund is up 5.96%, and the DFA 7.22%. I think this shows that there are times that a passive can work as long as it is updated. If we slash the wrist of any analyst, and a historian will bleed. In studying successful investors, we have found that they tend to invest in extremes, not the middle. They concentrate. Often a family's wealth is tied to exactly one single investment. And at almost any time, they are contrarian when they begin. They see things others don't. They have a willingness to be lonely, but they stay within their circle of competence. This term, circle of competence, is a term developed by Charlie Munger and Warren Buffett at Berkshire. Interesting that when Warren Buffett met Bill Gates, one of the founders of Microsoft, and they had a wonderful conversation, Buffett did not buy Microsoft and hasn't. But, and the reason for that is he did not understand computers. He did not have one himself that he used. But he did reasonably well without that because he was able to understand cash flow and, most importantly, leverage. This is an example of staying within your circle of competence. It is this approach to investing that I think makes sense. Now, let me go back for a moment on the difference between the U.S. and here. And the U.S. fund industry is not the driver of its own success. The driver of the success is the recognition of the society through the politicians, and I will say urged by appropriate lobbyists, that there is a retirement problem. And a series of laws came by which created the use of defined contribution plans, which for the most part are mutual funds. And this has been the great growth of the fund business, not only the money going in by employee selection in various corporate plans, but the introduction of funds to the employees when the employees roll out of these plans often, in terms of good tax management, they roll it into an individual retirement account, which preserves their cost basis, and they do not have to pay tax until they start to withdraw. Now, unfortunately, they have to begin to withdraw at age 70 and a half. But this has built a relationship to get into that 40 to 50% of the households. And I see this missing in India. Yes, you do have some pension plans. Yes, you do have some retirement interests, but it's not a driver. If we go back to our friends in the UK, one of the more successful groups has the name Save and Prosper. And this is the message that I think needs to be transmitted to your audience. Try to stay away from focusing on, we will enjoy this wonderful bull market that you are enjoying, we'll beat the indices, which you are currently doing, which means statistically you won't at some point in the future. I'm not making a prediction over a long term, but at some point, because you beat, by definition, you'll lose at some point. That's the wrong discussion. The discussion is building the payment mechanism for retirement, for passing on to families, etc. And now, this is right, I want to thank you for your patience and look forward to your very good questions and very few direct answers from the speaker. Thank you.
Thanks, Mr. Lipper, for that address. I'd like to call on stage Sunil Subramaniam, CEO Sundaram, for helping us take some questions from the audience for Mr. Lipper.
Hi, good morning, everybody. And thank you, Mike, for a very insightful and incisive speech. Before I open questions to the audience, there's a burning question in my mind. So let me kickstart that. What I noticed from your speech, and you quietly slipped it in, is that you believe more in active fund management versus passive, right? Is that correct? In your own portfolio and your own thing?
At this point, for specific accounts, we have about 30% in passive, but a good bit of that is of the non-index version.
Okay, so 70% is in active.
Correct.
Right? The reason I bring that point is one of the things we in India have been consistently bombarded with is that this whole alpha generation, which is very true and relevant in our industry here, is kind of going to go away because there's this famous quote attributed to Warren Buffett where he said that the US investors have wasted $2.5 billion in asset management fees when they should have simply been putting their money in index funds. And that's one of the challenges which our industry is facing here is this drive towards passive and whether the alpha can be sustained. But I'm very happy to hear from a veteran investor that 70% of your allocation is to active. So I think that's one thing which is, I think, really good news from our perspective. But then I was just curious about what Warren Buffett said and how do you respond to that?
I am an extremely lucky person because we've owned Berkshire Hathaway for a long time. If you watch Warren Buffett, watch what he does, not what he says. Okay. 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 He is a great, great promoter. He is an active manager. What does he want? He wants the rest of you to go passive so he can pick up.
Thank you.
I mean,
very, very enlightening, right? So now I think the questions from the audience can... If I can have the lights on a bit so I can see if somebody's asking a question. Yeah, hi. Can the mic be passed on to you? So can you just introduce yourself briefly and then your name and then the question to Mr.
Okay, my name is Deepak Hemani. So just in continuation to what you just said, there are these trillions of dollars which are moving into ETFs and index funds in the US. A lot of money is actually coming out of active funds. How do you respond to that, and how does this portend for the future?
Most of the money going into ETFs is trading money by hedge funds and other short-term traders. There isn't that much retail money going in, and certainly the retail money is not going into the smaller sector bets in the ETFs. Again, you have to look at the data on ETFs, and you have to look at the spread, the buying spread between the net asset value and what you actually pay. And you have to understand that in the US and other markets, the only people that can actually trade with the underlying fund are called authorized participants. The authorized participants are, in effect, dealers. They also have positions in not only the fund, the shares within the fund, and other things. We, as the public, don't know what their capital is like. We have an experience in the US in 1987 when we had actual specialists on the floor of the New York Stock Exchange that were meant to keep the market even. And we took a 25% hit in one day. We had one very good specialist firm go bankrupt that day because they tried to do the right thing. There will be issues like that with the ETFs. The ETFs, again, is focused on the short term. Your need to go from a 3% penetration to a 40% penetration is to drive people to be thinking long term on payments. You can't spend relative performance. You can only spend your currency.
Thank you. Thank you. Yeah. Can a mic be passed on to?
Hi, I'm Nisreen Mamaji, and I'm an independent financial advisor. There were 2 points that I needed to get your advice on. One is you mentioned the power of communication, and the second is to make retirement funds, the investment in retirement funds, perhaps linked to a tax-saving instrument or mandatory in order to promote long-term investing. For this purpose, do you feel like a general communication, like an ad campaign, would pull in the investor, or a one-to-one communication via an independent financial advisor, or through the conversations that we've been talking about? What do you think is a more powerful way of investing and getting people to have confidence in this medium?
First of all, I'm delighted to have a question from a lady.
Thank you.
The second, in communications, to your own self be true. And what's the best way for you as an individual? In the US, many financial advisors present courses in adult education schools. Others speak at various meetings, not investment meetings, but the local garden club, a seniors group. The history in the US is most individual advisors and some broker-dealers make most of their money on references from existing. So it's a very legitimate question of people of wealth. Tell me who some of your clients are, and let me talk to them. They should be your cheerleaders.
Thank you.
Thank you. Yeah, I think right at the back. Yeah.
Yeah. Hi, good morning. My name is Ritesh. I'm an independent financial advisor. You mentioned in one of your slides that a lot of your investors are focused or concentrated on a particular kind of investment channel. So, we in India, as a young country with a young population who have many years of investment before we actually start cashing in, what would those sectors or those concentrated investment products be in the mutual fund space that, according to you, would be good?
It's a good question, and it's actually a top-down type of question. The history is more bottom-up. In many port cities of the world, the wealthiest individual is the owner of the garbage scows that takes garbage off of the ships in the port. You know, it's not an establishment name, and many people don't know it. So I think it's a function of finding where the skill set and the abilities are. The trick in dealing with these highly concentrated pieces is, one, to get them to think a little bit in terms of diversification. Mutual funds happen to be one of the best ways to diversify. Second, they all have children and grandchildren. And the majority of those children and grandchildren are either voluntarily or involuntarily not going to work for the family firm. There is a need of the patriarch or matriarch to help them invest. Mutual funds are a very good way to start people investing. In the US, some of the funds do an excellent job of communication. And the thing that I like the most is they start the discussion with the stocks that detracted from their performance. They also talk about the ones that aided. It's actually in the detraction, which is the great lessons. My whole point is, and among other things, I'm a trustee of Caltech, and Caltech is a bunch of scientists, and what they wind up doing is experimenting. And the majority of experiments don't work. That's actually where they learn. And my point is, if you have the right communications with your accounts, the learning of mistakes builds relationships and hopefully helps you make the correct decisions going forward.
Thank you, Mike.
Okay.
Right. Any other questions? Right, while you all think, let me jump in with another question. Mike, it started off with this 97% savings and moving people from savings to investments. One of the main challenges we face in India is that bank deposits are guaranteed by the government of India. And since the country's independence, not a single bank has been allowed to fail. So if there's a weaker bank, they take a stronger bank and merge it in with that. So people have this confidence in the banking system that my money is 100% safe, I'll never lose my capital, right? So in the US, right, I think banks, there are 500 or 600 banks which fail every year. So is that an important regulatory change, do you think, that needs to happen to shift people from this savings in banks mentality versus investing? Because that's the biggest roadblock that I'm sure all the financial advisors face here, is because returns are volatile here, they are guaranteed capital, and the return is also guaranteed.
Going back to William Shakespeare. There was a play called The Merchant of Venice. And I'm sure you know the story. But from a financial standpoint, the story was the cost of a guarantee. Think about that. When anybody guarantees something, there's a cost. Now you're saying, well, the government is guaranteeing. Yeah, and so you've socialized the cost of the guarantee. That also means, if you work out the math, the controls of the guarantor are typically so onerous that the rate of return cannot be competitive in the marketplace. So anytime I hear of a guarantee, my first question, well, what's the cost? And most people say, gee, I don't know. I say, then you don't know that investment.
Okay. Any other questions? Yes.
Good morning. Good morning, sir. This is Krishna from iVentures Delhi. Sir, I have a question. Like, what is the how robo advisory is going to change our industry, and what impact will it have on the investment management? What's your take on that, sir?
There are any number of people in the room who probably have much better views on that than I do. All that I am conscious of is the unintended consequences of any move are normally bigger than the intended consequences. The second thing is it's going to increase the volatility and the momentum of currency, which may change attitudes. The faster currency moves, the bigger the chance of finding some good investments. But I can't tell you exactly what will happen.
Thank you. Thank you, Mike. I think we've just run out of time. So thanks a lot for all your questions. And thank you, Mike, once again.
Pleasure.
Thanks, Mike, and thanks, Sunil. I'd like to invite on stage V. Ramesh, MFU, for a small felicitation for Ms. Silliper.